Stop overthinking the VA loan funding fee. The VA loan is one of, if not the most incredible financing options on the market, and yet people still try to find reasons to complain about it. It drives me nuts. So if you are worried about the funding fee, watch this whole video. You talk yourselves out of using the VA loan because the funding fee is terrible. Or you convince yourself that you need to put money down to buy down the funding fee because it sounds terrible. It isn't. So I'm gonna break down my thoughts on the VA loan funding fee here because I get asked this question all the time and I just realized that there's a need for this breakdown to be in existence. First and foremost, what is the funding fee? The funding fee is essentially an origination fee, just like other lenders have, that is used to help keep the cost of the loan for US taxpayers lower. Because the VA loan doesn't require down payments or monthly mortgage insurance, this is kind of a requirement. It is what it is. So the funding fee is wrapped into your mortgage and it's paid when you close the VA home loan. This funding fee is a downside of the VA loan, but it really isn't that bad. So on a $200,000 property, the funding fee is only like $4,600. Assuming you were to pay 4% interest on the loan, this funding fee could cost you a whopping $22 a month. So in my opinion, paying $11 a month for every $100,000 in loan amount is absolutely worth not putting 20% down in order to use a conventional mortgage, right? So home loan funding fee amounts differ, but you know, it is what it is. It's 2.3% for your first use and 3.6% for your subsequent use if you put no money down. If you put 5% down, it's 1.65, and if you put 10%, it's 1.4. So really not enough of a savings there to justify having to put $5,000 or $10,000 down per 100,000. Now, funding fee amounts for other VA home loan types, like the IRRRL is a 0.5%, which if you watched my video last week, you'll see that. Manufactured home loans, right, like a mobile home, it's a 1% funding fee. If you're assuming a VA loan, it's a 0.5%. If you're using the Vendy loan for purchasing like VA acquired property, it's 2.25%. If you're doing like a Native American direct loan, a NADL, that's 1.25 or a 0.5% for your subsequent use. And if you're doing a VA-backed cash out, it's the 2.3 for first time and 3.6 for, and I'll put a table in here so that that looks better, but, or you can look at the article. Now, circumstances that waive the funding fee, right? So the most commonly known way to avoid paying the funding fee is if you have a VA rating of 10% or greater for your disability rating. That said, there's several other ways. I went ahead and just copied it straight from the VA Gov website because it's really just a good breakdown, right? So you won't have to pay a VA funding fee if any of the below descriptions is true. If you're receiving VA compensation for a service-connected disability, or eligible to receive VA compensation for a service-connected disability, but you're receiving retirement or active duty pay instead, or the surviving spouse of a veteran who died in service or from a service-connected disability, or was totally disabled and you're receiving dependency and indemnity compensation. DIC, Duke. Or, couldn't resist, or a service member with a proposed or memorandum rating before the loan closing date saying you're eligible to get compensation because of a pre-discharge claim. A service member on active duty who before or on the loan closing date provides evidence of having received the Purple Heart. You may be eligible for a refund of the VA funding fee if you're later awarded VA compensation for a service-connected disability, right? So you just got to ask that question. Now, the effective date of your VA compensation must be retroactive to before the date of your loan closing if you think you're eligible for a refund. If you think you're eligible for a refund, please call your VA regional loan officer or whatever at 877-827-3702. All that's on the article, right? So they're open and they'll be happy to talk to you. So why is the VA loan funding fee better than using the FHA loan? If you focus on the negative view of, but the funding fee stinks, you'll somehow come to the conclusion that the FHA loan could be your better option. And let me just tell you that this is dead wrong, right? I got talked into using my FHA loan to buy my first duplex by my lender nonetheless. And that has cost me well over $10,000. And if you watch some of my other VA videos, you'll figure that out since closing on the property. The VA loan is much better. The first reason is mortgage insurance premium. The FHA loan requires that you pay a mortgage insurance premium, which is 1.75% of your loan amount. So right off the bat, on the $200,000 home example, this is $3,500. So keep in mind that the funding fee is not charged up front, but rather wrapped into the loan and paid down over the course of the mortgage, right? So that $3,500, the MIP, that's up front. Now, there's also private mortgage insurance, PMI, right? So to make matters worse, this PMI is added to the FHA loan as a sort of ongoing mortgage insurance premium. This PMI ranges from 0.45% to 1.05% of your original mortgage amount, depending on the amount of your loan, right? So the amount is divided by 12, and then the amount is added to your monthly payment on, so on our $200,000 home, the PMI would be 0.8% or $1,600 annually. This loan, on this loan, PMI would equate to $133.33, and then a whole bunch of other threes, a month added onto your loan payment. So here's a short down and dirty comparison of the difference between the VA funding fee for the VA loan and the mortgage insurance premium and PMI payments on the FHA loan on our $200,000 example. So with the VA loan, you would have taken the funding fee and you would have it wrapped into the mortgage. You would pay $0 up front on it and roughly $22 a month for the duration of the loan, totaling $4,600 over the course of the loan. With the FHA loan, you would pay the $3,500 mortgage insurance premium at closing, and then you would be responsible for paying $133.33 monthly in PMI in addition to that, right? So, and after just 1 year of ownership with the FHA loan, you would have paid $5,100 between MIP and PMI, and you'd still be on the hook for $1,600 a year in PMI expenses until you got below that 80% threshold. Oh, and by the way, try to convince your lender to waive the MIP and PMI expenses on an FHA loan just because you have a VA disability rating of 10%. Let me know how that works out for you. They don't care. The VA loan is $0. The only way to get rid of MIP and PMI expenses is to put a lot more money down than you want to, right? Like if you put 20% down, you probably wouldn't have these, but why would you do that if you're trying to use one of these low down payment options, right? Like it doesn't make sense. It's kind of counterproductive. So again, the funding fee isn't that bad. The VA loan is an incredible benefit for service members. All right, so why shouldn't you worry about the fee? The bottom line is that the funding fee does cost you a little bit of money, and it does get wrapped into your mortgage. It might mean that the VA loan is not a perfect zero down, no money, nothing ever, wonderful, whatever, but someone's got to make some money, right? Like there's got to be something for this benefit. So it doesn't, however, ruin the VA loan. I hear negative people comment about, oh, but the funding fee sucks all the time. And the reality is that the funding fee is substantially better than what you would pay on other affordable primary occupancy loans. Personally, if I was to buy our $200,000 example house, I would much rather pay $22 a month than have to cough up $40,000 as a down payment. Now, I say that without even going into the concept of opportunity cost and the present value of the money, but just for sake of argument, if you had the money for the $40,000 down payment, you could stick it into even just a crummy savings account, just a savings account. And as long as you earned 0.0066% interest, you would earn enough interest to cover the funding fee cost. My bet is that you could invest $40,000 almost anywhere for more than 0.0066% return on your investment, which is exactly why you should not complain about the funding fee. It is chump change. Like, who cares? Now, I would like to throw this disclaimer out there real quick. I'm not licensed in any capacity to work with mortgages. I just do my homework. I also did this math on a desktop calculator, so if the numbers aren't perfect, they're just rounded, whatever, I apologize, but you get the idea, right? And that's the point, is getting the idea. Also, these fees do change from time to time, but I'll update the written article with percentages when they change. So definitely check the link out if you want to go see that. And as always, subscribe to the channel, click the little like button, like click the bell for notifications. It would mean a lot to me. All I'm doing is putting out this free content, so have a great freaking day.